So at this point, we've looked at flexible premiums. We can see that as the policy owner, you have the ability to manipulate the premiums paid. Even one step further here, if you have a good account value built up in your policy and you fail to put more money in, so you stop putting more money in, the insurance company will use what looks very much like the automatic premium loan option. They're just going to take the money right out of the account value to pay your expenses and your cost of insurance. And for some people, this is their goal with their universal life insurance, to have built up so much value here that they're going to get more growth than the amount the insurance company takes out to pay the cost of insurance and expenses. And this is realistic. Some people get their universal life policies to that level. We've seen flexible coverage, 4 different death benefit options. This is where it gets tricky, though, determining who should acquire what type of life insurance policy. Assuming we have a client who's going to be somewhat investment-oriented and seeking some flexibility and is going to actually manage their policy, we now have to decide what type of death benefit is most appropriate for them and which of the funding options, whether a level or a YRT cost of insurance, is more appropriate. Now, we talked about that decision a little bit a few minutes ago, but I'd also like to talk about what leads people to each of these. So normally, where you have somebody who's trying to keep their costs in control, maybe so that they can maximize their investments, you're typically going to go to one of the less expensive options, maybe the level or maybe the level indexed option. If you have somebody who's maybe in their 30s or 40s, has a family already, and is buying the universal life insurance primarily for the purpose of building protection in case of their untimely departure, then you're typically going to go to a level plus total account value. And that's generally what you'll find, is people who are in that family type of situation will often choose level plus total account value. When business owners acquire universal life insurance, when a business buys universal life insurance on somebody within the business, it's not uncommon to use the level plus cumulative gross premiums option, because what happens then is that at the point where we have a death of the life insured, the business knows that whatever it put into the policy, it's going to get back out of the policy. This can help to manage some tax complications that can arise that are really beyond the scope of this course. It also allows the business to know for sure that whatever money they put in, they get back out, which keeps accounting clean typically. Then we move on to flexible investments. We already talked about this in some detail, that there are a number of investment options available. You'll find some insurers that offer hundreds of investment options within their universal life policies, and some that offer a fairly basic selection of investment options. The product is consumer accountable, so we said the consumer has to be the one to make decisions about how the universal life policy is going to work. And finally, it is a transparent or unbundled product, meaning that the consumer can see everything that's happening. They're going to get regular statements that are going to compel them to have a look at those statements and decide whether they want to continue down the path they've chosen, or whether they might want to change the amount of premium they're paying, or whether they might want to change their investment structure. Typically with the coverage, we don't have the opportunity to change that once we're in the policy. So universal life insurance is a fairly complex product. There's a fair bit to know, and you will be expected, for the purposes of the exam and in real life afterwards, to be able to assess what kind of universal life insurance policy, or if you're even going to use universal life insurance for a particular client. Keep in mind tax-deferred growth or tax-exempt growth, which is a powerful characteristic, the ability to borrow against the policy later on, which is useful. We're going to have creditor protection of the account value if you've named the proper beneficiary, which is the same as for whole life. We're going to have the ability to build a death benefit to meet our needs. It's a very good estate planning tool, and used properly, the flexibility from universal life insurance can help a client to meet needs that occur throughout their life cycle. I hope at this point that you understand a little bit better the functioning of universal life insurance. As always, feel free to contact us with questions, and enjoy your continued studies. hope that you're finding it beneficial, and I hope that you're achieving your aims. Thank you very much.